I tell you, there's this old, it's not an old saying, but there's this expression when it comes to wealth, right? The first generation creates the wealth. The second expands the wealth. The third destroys the wealth. Okay. That's because first generation parents worked their asses off, the sacrifices to make you very successful. The second generation saw how hard their parents worked. Okay. So they know. The third generation never saw how hard their grandparents worked, but they saw the benefits of it. So they had their expectations from when they were born at a different level. And so this is why not many generations go past 3 or 4. And that's where it does. Unless you tie them into an entity that's not saleable.
This is the Entrepreneurs United podcast with your hosts, John St. Pierre and Rich Hoffmann.
Entrepreneurs, we got a treat for you today. We're sitting down with Jay Raffaldini. And Jay, you do a lot of things, but let me just set the table here to start with everybody. Over 25 years ago, you started a hedge fund, O'Connor Hedge Fund, and you still work within that hedge fund today at UBS. And you have a lot of stories and history in that, but then also you started following some passions of yours somewhere during that period. And you also own a winery down in North Carolina that actually Rich and I are going to be down in North Carolina pretty soon, October 6th to the 8th for the Entrepreneurs United Empowerment Experience, and get a chance to meet you in person. And we wanted to bring you on the podcast today to really share with our audience a little bit about your learnings through 25 years of building this hedge fund and following some of your passions. What was it? What was the one biggest learning that you would say, of all of my learnings, this is the one thing I want to make sure your audience hears today?
Okay. Thank you for the background. So I started Wall Street in 1985, and I started the hedge fund in 2000. And I think over my life, there were like 3 or 4 forks in the road that they don't look like a fork until you've actually gone down the road. Right. And I remember when I was in the mid 90s, I was having some success on the trading floor. I was 36, right, years old. And this old trader came up to me. He was probably like 45, right? He goes, "Jay, came up to you." "Yeah, well," he goes, "let me tell you something about Wall Street. You feel your oats right now, but there are old traders and bull traders, but no old and bull traders. Because eventually you get walked out the door either through force or you're retiring. So have a second act planned in your life." And that was my first thing. That was like, okay, someone telling me you need to think a little bit about it. And at the time, I love wine, right? And if you have money, you have wine, there's only 2 things you can do. First thing is a fancy cellar that you show off your buddies to, or second is start a business. And the reason that I wanted to go down the business route was I managed money for a lot of wealthy families. And what I've noticed over time is that when your heirs inherit things that they can sell, like stocks and bonds, they tend not to make good choices, particularly unless they're like in their 20s and 30s, right? You go about a Ferrari, you're doing all the stupid stuff, right? But if they own a business that they have to work together as a family to increase the value and live off of that, then it's a completely different outcome. And you have the heirs are more well-rounded, and B, you have a higher chance of success, and it keeps the family together. Okay. And so that was the thought process. That's why I wanted to do the business and not just build up a big securities portfolio. And when I die, watch them just piss it all away. So that was the initial thought process. And that's when I started to focus on the Vineyard in the year 2000. But why I chose North Carolina was one of those lessons that thoughts I'd like to impart to entrepreneurs is that 25 years ago, there's only 5 vineyards in North Carolina. Okay, that was it. And to make the style of wine that I wanted to make, there was none. Virginia, some, but everything was out west. So the easiest thing would have been to do what everyone else is doing where they were doing. But I said, no, I'm going to do something where no one's at. So you want to do, so it's kind of like a fish pond thing, right? But it was more like, if I can do something where no one's at, I'm creating a market. I'm creating a place I'm not crowded on the shelf. So when I found this piece of property in North Carolina, it's about an hour north of Charlotte, maybe 30 minutes west of Winston. What they did is that while no businesses were there, a lot of customers were around there. So if you look at it, within a 3-hour drive of, for example, where I'm at, Okay. You had the same amount of people that are within a 3-hour drive of Napa and Sonoma. Okay. Yet there's 5 vineyards here and there's 2,000 there. So the whole idea is to be where the customers are. Okay. But with no competition is. So that's why I started, and that's where I planted the flag. Okay. And then the other parts of the journey that were unexpected was you don't want to ever be by yourself once you're established. Once you're established, what if others around you doing like-minded things, particularly in hospitality and tourism, right? In other words, for example, you'll never hear anyone say in your life, I'm not going to Napa because there's too many wineries. That's why you go to Napa. Okay. So you want to be, there's this thing called clustering in the business world, which is why Silicon Valley's been successful and Napa's been successful, right? All these restaurants in these areas are successful. You're with each other. So that's when I started to buy land around me and sell it, around me, adjacent to me, and selling it to other people to start the vineyards. So then I had started the clustering. When you cluster, you also build knowledge. Okay? Oh, I didn't think about that. My neighbor did that. Well, that makes sense to me because we had the same challenges here. So the first part of it was to see what the customers are and not see where there's a lot of competition, right? And then second, once you establish yourself, start to put others around you, and then you can start to build off that base of knowledge. Yeah, this is absolutely essential, no matter what industry it is. We look at places like Greensboro that becoming a manufacturer, either aerospace hub and a transportation hub, or Charlotte being a financial hub. When BB&T and SunTrust merged, okay, you had Winston-Salem on BB&T and SunTrust in Atlanta. They chose Charlotte when they formed Truist. Why? Because other banks were there. This is a clustering principle. Okay. But you have to be early on in that area. Otherwise, you're a follower. So the message here is that go to where no one's at, see if the market can support that. And then once you're there, start building out and you have that knowledge base. So that was not, definitely not a master plan. That's kind of stuff you figured out along the way. Oh shit, I should have thought about that. I don't want to.
Where did you learn to pass a business along opposed to pass something sellable or cash assets along?
Yeah. So again, I tell you, there's this old, it's not what I'm saying, but there's this expression when it comes to wealth, right? The first generation creates the wealth. The second expands the wealth. The third destroys the wealth. Okay. That's because first generation, parents worked their asses off, the sacrifices to make them very successful. The second generation saw how hard their parents worked. Okay. So they know. The third generation never saw how hard their grandparents worked, but they saw the benefits of it. So they had their expectations from when they were born at a different level. And so this is why not many generations go past 3 or 4. And that's where it does. Unless you tie them into an entity that's not saleable. Okay. So, for example, we manage money and Wall Street for some of the very high-end fashion producers in France and Italy, right? We're talking 20, 30, 40 generations because they are privately held. Okay. There is no stock to sell. And if you're successful, you live off the dividends, you live off the interest, but the core of the business is maintained. I get how many times I've seen generations when they have the first generation monetizes it, and then it goes to stocks and bonds or something liquid. It's always much less when we receive it. Yeah.
Have you read the book Family Fortunes?
I have not.
Interestingly, what you're talking about as a strategy is in that book. And John, I forget which one of our podcast guests recommended it, but I bought it after there was a recommendation. And the book is all about passing on multi-generational wealth and doing that through businesses and people growing up and learning what you do for work is you work in the family business. That's what you do. And you get paid your share out of the family business. And that just becomes the legacy that goes on and on.
Because if I was 30 years old and my parents died and I was given a ton of money, I'm pretty sure not many good things would happen from that. I mean, it's just human nature when you're young, right? It's what it is.
Yeah.
You want to buy nice crap, and that's just what it goes.
Is your hope that the winery is that for your legacy?
Yeah. So the reality is that I tied in my family and my nieces and nephews. So they're all, when I pass, they all have ownership stake. There's 5 of them, and they have to work together. And they set up in such a way that no one can buy each other out. You have to live off of it, and they get passed it along. So that's my expectation. And then this friend of mine said, "So what happens if all of them get together when you die and they sell it?" I said, "Dude, I'm dead. What am I going to do?" I can't come back from the grave to haunt them and stuff. But ultimately, that you could give them the parameters to be successful, and how they use those parameters is a function of hopefully you did the best raising them and things like that.
Jay, I'd like to get a little more specific if you don't mind. And Rich, I do remember somebody bringing up that book. I can't remember who, but I never got the book and now I need to go get it. So that's part one that I'm going to remember, Family Fortunes. And Jay, I was going to ask you right before you said that, I was going to say, how? How do you tie their name to an entity that's not saleable? And you said a few things. You said, give them an ownership stake. They cannot buy each other out. They have to live off of it. How functionally, if I'm thinking about that, because I have a couple of businesses, I have a holding company. If I was to structure this and you were to give me a little bit of a more, it doesn't have to be your exact roadmap, but you give me like an example of what a roadmap could look like. How would I legally structure that? What kind of entity is it? What is the operating? Like, I'm just curious. I know a lot of entrepreneurs may be listening to this going, okay, this is interesting. How would I do that?
Yeah, you set up a non-revocable trust in an LLC format, and how you're able to manage it is the 5 of them. In my case, they'll probably say, I don't want the burden of running this, so they all get together and appoint a general manager to run it on their behalf. It's hard to get 5 people to think in the same direction. That know us 2 or 3, but I think when they appoint a GM and the GM has a specific goal, we need such and such income off of that, then he's able to devise the plan. So I think that's how you work it. So just because you're owner doesn't mean you're an operator. Big difference. Okay? Owner operators are usually in the first generation. Second, maybe third, so when you have a lot of owners, then you need, and usually a non-family member as an operator to avoid conflicts of interest and stuff like that.
Got it. Did you say irrevocable trust initially?
Yes.
Okay, so you set up an irrevocable trust.
Yeah.
To which the beneficiaries of the irrevocable trust are the people you want to have ownership in the business.
Yeah.
They, in essence, become the board, if you will.
Yeah.
They cannot sell their shares. It's a trust. You can pass it down, but they're on the board, and then they appoint a GM who gets paid to be the operator to run the strategic plan of the business. How do the owners of the irrevocable trust generate annual income from their board position? Or is it not, they don't generate that, they generate wealth through that, but they have to have an operating role to generate income?
Yeah. So they draw income off of the success of the GM, right? So the company makes 500,000, you got to file them, everybody draws up 100,000, yet the value of the entity is maintained. So what you're doing is that business has to survive. Once all the business's needs are met, then everybody can live off of that.
Okay, so the board would have profit sharing interests. So if there's 5 people on the board, 20% each as an example, and there was excess profit of cash flow of $500,000, they'd each get $100,000 of profit interest. But that doesn't mean they still own 20% of the business. They're not selling their interests off.
Right.
So in the future, let's just say I own 20%. Let's say I was one of these people who owned 20% of this business. I would then have in my downstream of my kids, if you will, I have 2 boys as an example. Eventually, they may own 10% each of this particular business and get 10% profit sharing as opposed to 20% profit sharing, and it continues downstream that way. Is that kind of how the way it's structured?
Yeah, the idea is to make it through 3 generations, right? It's kind of like the finish line. That's the finish line, right? Beyond that, who knows, right? But you can also do it, and you can set up certain encumbrances where they cannot put debt on it. Suppose the vineyard's booming and they want to expand.
Yeah.
Example. All 5 of them would need to sign up for debt because 5 of them are legally responsible for the debt of the business. So there are ways to really tie them in, but when they live off of the success of the business, they're motivated to help the business.
Yep.
to be a passive participant. We want active participation,
Yep.
so that's the hope, right? You want
Yeah.
1 month, help the business grow.
Rich, I appreciate you letting me jump in. I just had a few questions on the structure of that. Didn't want to cut you off where you were going. Did you have any more questions on this particular angle? Because I was going to go in a different one next.
I just want to tap into with the hedge fund business. What were the lessons that you learned there that then immediately applied to the winery?
Yeah, the company I started with my partners in 2000, so we started with $50 million in seed capital, the hedge fund business. And by 2007, we were at 17 billion very quickly. And I remember I was like, dude, I mastered the universe. Gordon Gekko and got shit on me. This is it, right? And then, of course, we had 2008, like shortly thereafter. So it was one of those moments you're like, when something comes out of nowhere and hits you. And even though I was on Wall Street, we always knew there was a subprime problem in 08, but not the magnitude that brought down Lehman and Bear Stearns. So we have something that is a what we call 5 sigma or 5 standard deviation event. It tends to focus the mind. And then you're like, okay, so what do we need to do to repurpose the vineyard? Because you can see it. The economy is in a massive free fall. So every now and then, when you have those existential moments, it gives you a chance to rethink your core philosophies. Okay, we had to downsize the hedge fund. We had to reposition the hedge fund. We had to maybe think about things doing a different way at the vineyard. Maybe focus more on on-site visitations, less on distribution, things like that. And you come out stronger. So the hedge fund went from, we were at 17, we went down to 11, then we got up to 50, right? And so that was tremendous. And the same thing at the vineyard. We finished building the villa to drive people there. And then we get 20,000 visitors every year now. But if you don't have those existential crises, you get lazy in the thought process. It's working. Why mess with it? But every now and then, that's a good thing to happen because you really, such old saying, a good hanging tends to focus the mind. So when the news is hanging overhead, you're like, okay, maybe just think about another strategy. Then I think I think a crisis is really an opportunity to rethink the core principles that you have and adjust. Otherwise, I think we tend to get, everything's fine, why bother? I think I'll tell you why that's a bad strategy, because your competitors are not thinking like that.
Oh. Yeah. And Jay, what you're really talking about here, I think is worth repeating. Like it's when you have those failures, those crisis moments, those existential threats, that you have to review your core philosophies, your core principles, where you're going, what's this all about? And, I've had certainly moments like that. Rich has, we all have, and they are defining moments, right? Failure's not a failure unless you quit. But when you do have those moments, you have to pick yourself back up and figure out, okay, where am I going? And if not, you're complacent. You're just stuck there in complacency, running through the motions, not realizing anything's wrong. And yet these crisis moments aren't fun. They really challenge you. Can you bring us maybe to an example of one of your toughest times and moments? You give us an example of 2008, maybe there's another one, and how you process that when you're in those moments and how you react to them and how you learn from them. What's your philosophy around those moments specifically?
So I'll give you an example of Wall Street, then I'll talk about how it impacted the vineyard. So when you look to hire traders, for example, okay, the skill that matters the most for a trader on the hedge fund side is not how you behave when you win, how you behave when you lose. This is critically different, right? Because human nature, okay, is that you tend to hang on to losers too long. You can see this all the time, right? So if you buy a stock at 10 and it goes to 12, you're selling it, you made money, right? If you buy a stock at 10, it goes to 8, you're frozen. You're hanging, it's going to come back. Didn't make a right decision. Market's wrong. I'm right. Then it goes down to 6. You're hanging on with it. So most traders that are not successful hang on to their losers much longer than their winners. Okay. So one of the things that you have to, so using the same example, retail traders, they buy at 10, they sell at 12. Okay. Make money. They buy at 10 and it goes down and they hope it comes back. hedge funds. This is how we trade. Okay. We buy at 10, goes down to 8, we sell it out immediately because we're wrong. Okay. Buy at 10, it goes to 12, we buy more. Goes to 14, we buy more. 16, we buy more because we're right. So whatever is working, we do more of. Whatever is not working, we do less of. Critical. So hedge fund guys are buying as it goes up and selling as it goes down. Different for every retail investor. Okay? Retail being non-hedge fund investor. So we mentioned to you is when I first planted the vineyard, I had 30 acres planted. Okay? And I started to see bad decision. I had these vines here. They were giving me average grapes. I ripped them out. I ripped out my entire vineyard 3 times, 100,000 vines I pulled out because I had the wrong grapes to make what I thought was successful. Okay. So some of my other people in the industry were like, oh, you're ripping out all these wines, these vines, you're losing so much money. I said, nothing's more expensive than unsold wine that's finished in a bottle that nobody wants to buy because the wine sucks. So again, that mentality of do more of it working and less of that working is a very emotional change that you have to be able to do. If you have something hot, keep feeding it. So because kill it. So we actually have what we call psychologists on board here, where they work with people like, why do you have the position? It's not working. The reason you did that no longer exists. Get out. So that's a personality trait. Has to have a grade. It sounds easy, but it's quite hard to admit you're wrong.
So I'm going to expose myself as a retail investor and clearly not a hedge fund investor.
Sure.
The obvious pushback to that strategy, I think, is you buy at 10, it goes to 12, you buy more, it goes to 14, you buy more, it goes to 16, and then there's a correction and it all goes back to 13 and you never made money.
Well, if it goes back, what happens is when you buy 10, that goes to 12, and you buy more. And then what you do is you raise your stops as you go higher. Okay. So it's at 14, your stop is at 12, and 16, your stop is at 14. So you're doing average up.
I got it. I do that in gambling. It's creating a stop loss.
Yeah.
So, you sit down with $400.
Yeah.
You want to walk away with at least 200. You have a win limit. If you're sitting on a win of 275, then you create your stop loss at 200. You can gamble with the other 75. It goes up to another 125, create your stop loss now at 300.
Exactly.
So, yeah, I totally get that. So it's the idea of creating stop losses that gradually go up. So it does, if it goes to 13, you already sold out when it was at 15 or 14.
Exactly. But not many retail investors invest like that. Okay. And where they don't use stop losses is when it goes down against them. Here's how they behave. Stock goes to 10, it's at 8. I think the market's wrong. I'm right. If stock goes to 6, they buy more. How much is averaging down is the road to poverty. Averaging up is not the road to poverty. It's a road to success. Investor behavior, it's not in the day. I'll give you another random example. Over the past 30 years, the average mutual fund in the U.S. has gone up about 8%. Okay? The past 30 years, the average mutual fund investor is up 4%. What's that 4% difference? Making bad timing decisions. That's the problem.
Of getting in and out of the mutual fund.
Yeah, this is why. So we have to understand what our personality trait is. Because some people, like we have high tolerances to knowing that. So one more trade example, right? So if you look at our composition trading, 60% of the time we're wrong. 40% of the time we're right, but our winners run, our losers are cut. Okay, that's how you do it. So you say again in the vineyard, right? If that one grape is still a grape, I'm going and run. But it's an emotion. You got me to admit you're wrong. It's really tough. Really tough.
Tell me about what inspired you to do a TED Talk 8 years ago and that jellyfish TED Talk?
Yeah, I have two passions. One is, being on Wall Street's not a passion. Wall Street's a mean to an end, right? I never grew up saying, hey, I want to be a hedge fund trader. I grew up with two goals. One is to follow Jimmy Buffett because I'm a parrot head since I was a young guy. And the second thing is I like to drink a lot. So when you have a combination, you like wine and you like Jimmy Buffett, these are the two goals. So my main goal was to just follow what they call a parrot head. You follow them around and just pretty much drink a lot of wine. I didn't have high ambitions, right? But I knew that I needed to make money to do that. Okay. So I needed to find a way to really pursue that passion. And one of the songs that Jimmy Buffett had that I didn't really understand until later, the song is called Mental Floss. And it's on an album called Banana Land. No one's ever so long. And in the song Mental Floss, there's a couple of lines in there. It's called, I'd like to be a jellyfish. Clear as cellophane, riding the winds of fortune, life without a brain. The reason I love this so much is because so much of life is catching the wind of fortune. Right place, right time. You also have to be able to adjust. Okay. Wind shifter over here. That's where I'm going. But don't fight that. Understand the wind's at your back. But maybe you thought you should plant that grade and the wind shifted, you should do this and you do that. So the whole point of that for me, why I did the TED Talk was because we always have these master plans. Making a vineyard in North Carolina is not a master plan. Working on Wall Street wasn't a master plan. I just want to hang out with Buffett and get drunk. That was the master plan. But then here I ended up, I had no affiliation with North Carolina whatsoever. Zero. I'm a Wall Street guy. But then I found out this is a place, maybe not a lot of people around, I think you can make nice grapes. And then now it's the core of my life. So the idea of a master plan, I would really encourage everybody just to throw away. Be flexible to those changes. And when something is there, embrace it. But again, that's a personality thing. Just like trading. You have to be willing to change your life and willing to admit something is wrong. And the successful entrepreneurs have that in their DNA. Others maybe want a more comfortable, stable life. That's okay, but that's not entrepreneurial life. That's a corporate life. You just have to figure out what is in yourself, and then that will guide you on your career. Because
where's the balance between set a goal and drive to attain it and throw out your master plan?
I have no idea. It's one of those things like after the fact, you realize that's what I should do. But what I've always found is that your gut is always, your first instinct is always right. You tend to talk yourself out of it all the time. Right? Your gut is never wrong. Your first instinct, right? It's this way because I don't know, maybe no. So I would say if you just follow that, and then it will become self-evident that you made the right decision. Because the part of life that we have to talk about is happiness. You have to be happy in life. Yeah? And happiness just isn't the financial stuff. It's about the totality of happiness. The love of a family, good friends, and health, and all that stuff. So if you generally follow your gut in all of those areas, you tend to have a very good outcome in your life. So my thing is just be flexible, but be pragmatic. But that pragmatism is ripping it up, all your core beliefs and doing something different. Right? And if you can do that, you'll have a very successful entrepreneurial career. Well,
if we wanted to go on the website and check out the vineyard and people wanted to place an order, where would you like them to go?
Yeah, thanks. The website is my last name because I'm a narcissist, right? Or as my sister says, a megalomaniac, so you can pick which one you want, right? So it's RAFFALDINI.com. Yeah, but really, rather than place an order, I'd like you to come because you can see the output of all that effort. This beautiful Tuscan villa on a hill, but vines surrounded by all the other vineyards that I've encouraged to get next to me. And then you see it. And when you go there, you have what I call an exhale moment. Like you sit down, you have your glass of wine, and we're like, oh, we need more of that. In our quest to do everything we want, we need those exhale moments. That's what I want you to come. So don't order online. The only person I'll get on this on your podcast say, don't buy anything for me. Go there first, and then you see what's going on.
I love that and love the concept of the exhale moment. And John, I can't wait to get over and have that exhale moment with Jay coming up in just a short time.
Jay, thanks for joining us. Really appreciate the conversation.
Thanks, guys. Thank you for having me. And I wish all of you the best success. Follow your instinct. It's never wrong.
Look forward to seeing you soon, Jay.
You too. Take care again. Take care, buddy. Bye-bye.
Stay tuned as John and Rich unpack today's conversation.
John, your first instinct is always right. Can you think of an example where you either followed your first instinct and it was in fact right and it was difficult to follow, or where you questioned your first instinct and as it turns out, your first instinct was correct?
Wow.
If you can't, that's okay. But I'm wondering, I want to ground this into what's the reality of first instincts that you've either experienced or you've seen any of the people you coach experience?
Before I answer that, and as I think through the question, sometimes we Monday morning quarterback this. Oh, I knew I shouldn't have done that. If you knew you shouldn't have done it, why did you do it? So I think a lot of times we look back in history and we go, I knew my first instinct was to not do this. I could tell you there's been a conversation recently I was having with an entrepreneur that I coach. And we were talking about an employee that their gut was this person was not helping their business and they needed to go. And this conversation, by the way, happens a lot with entrepreneurs. Here's my answer. My final answer is the times where my instinct was this person is not good for my organization, or the entrepreneurs I work with are like, this person is not a fit in my culture, but we keep them there anyway. And inevitably 3, 4, 5, 6 months later, we think we're doing a good deed by keeping them on board. We feel bad. We don't let them go. They're a good person or whatever the answer may be. And we let them go finally. And the 6 months of destruction that we had in the business or the change we shouldn't have made, that we didn't follow our instinct. I've repeated that error, Rich, dozens of times. I think every single entrepreneur that I coach, every single one that I coach has experienced this moment. So if you're listening to this, I'm sure you have too, where you have somebody on your team who's not an A player, who's not going to help you get where you need to go. Your instinct is telling you this is not the right person, but you stick with it anyway. And you ultimately regret it. That is the age-old truth of entrepreneurs, is sometimes no good deed goes unpunished. You think you're doing a good job by keeping that person in your organization, when the good deed would be to let them go so they can start their career somewhere else and find the right person for your business. That, to me, from a business perspective, is probably the instinct I've overlooked way too often, and I refuse going forward to overlook it anymore.
Gosh, and as I reflect on what you're saying, I agree. The number of people who I've coached who have said, hey, I don't feel good about this person, and I just want to give them another shot. I want to make sure I did my part. I want to make sure I led them correctly and I exhausted all the possibilities. And we'd work on different strategies to set expectations, to hold accountability. I think I can think of 2 out of dozens that it's worked well to go against that instinct and put in that kind of extra nudge. So I would just double down with you and go, yeah, I've seen that time and time again. When your gut's just telling you the person's not a fit, they're just not working the way that they should be working. Like, they're probably not. There's a reason your gut is telling you that.
It's so funny because it's not the question you asked me, but if we just come back to what we just talked about with Jay, you got to double down on your winners, cut your losers. Yes. Double down on your winners, cut your losers. You're a retail investor. You're just like, oh, it's not working. I'm going to put them in a new role. They're going to work around other people. They'll work then. And then they go from an 8 to a 6. And then you're like, well, they've been with the organization 3 years and then you go to a 4 and you're still holding on to them. But the other way around, you have these performers. And those performers that are at these stock price evaluations, they're at 10 at your organization. Now they're at 12, they're at 14. They're looking down at the 6 going, what is this person doing in this company? Maybe I shouldn't be here either. And then you lose your top performers because, so everything we just talked about with Jay in these moments about retail investors versus a hedge fund investor applies to people and applies to following your instinct. And if you go with your instinct, Rich, and you make the decision that your gut is telling you is the decision, you're not going to look back at it and go, oh, I regret not making the call that I thought I could make. I'll live with the mistake. I'm going to make decisions. I'm going to make mistakes. I'll live with it. But double down on your winners.
I became aware of a study that was done on the top 25 tennis players in the world. And what the study aimed to discover was, what's the difference between the top 5 and the top 25? Was it the food? Nope. Was it the exercise? Nope. Was it the trainer? Nope. Was it what age that they started playing? Nope. It was how they took the loss of a point. And the top 5, when they took the loss of a point, they would bounce back and say, miss that one, I'll get the next one. Or, gosh, that was a good shot against me. I love this game. And get back in the next one. And the amount of energy that they would expend on negative feelings and losing points was roughly 0.
Wow.
So all the energy they had, they were able to put into the next play. So I think of that with what Jay's talking about in the number one skill for traders, he said, how you behave when you lose. I do have to tell you, I'm a really proud parenting moment. Our oldest 2 daughters, Kinley and Kaylin, they were in softball. And we had conversations with them about nobody cares that you strike out. All they care about is what you do next. Do you throw your bat on the ground? Do you look disgusted? Do you question the umpire? What do you do next when you lose? And that's exactly what Jay was talking about. When you lose, can you just call it a loser and sell it and move on? Or are you going to hang on to it like the other 20 of the 25 tennis players? You're going to hang on to it like the kid who's the softball player that every parent shakes their head at, who throws their bat on the ground as they strike out one more time.
Yeah, I love that, Rich. And it's all mindset. It's life as a mindset, which kind of goes back to being a jellyfish sometimes. Sometimes we take ourselves a little too seriously, and we take ourselves more seriously than other people should really take that moment, right? It's a strikeout. Who cares? It's not a big deal. But in our minds, it can get blown up. And so can failures in business. So can failures in life. And when we have those moments, yeah, maybe you should review your technique or your this or your that in practice. But in the moment, you got to rinse, repeat, let's go. Like, we got to make it work. And I love that study you talked about with the 10. I'd love to see the study, by the way. I don't know where you found this or saw it, but I'd love to have it. I think my boys could really enjoy that too. Because as you're growing in your teenage years, your foundational years for you and I, we learned this a little bit in our first roles out of college or in college even. That ability to regulate your mood and get through these tough moments and to really provide massive dividends through our lives. Because when we have had these crises moments, we've been able to pick ourselves up a lot faster than maybe people could think we could, because we did review real quickly our core philosophies, our core beliefs, and move forward, just like Jay was talking about here. So I really love that. And one piece I'll also say coming out of this, I got to go get Family Fortunes. It's certainly, to me, is one of the biggest reasons why we as entrepreneurs and business people do the things that we do, because we want to provide for our family. We want to provide for our heirs. We want to provide a nice life for our families. But on the same token, you want to provide a vehicle to which you can pass things on that is sensible. It makes sense for the long-term duration of not only my kids, but their kids and potentially future generations. And it's scary to me, quite honestly, that maybe after the third generation comes around and pisses away everything that everybody's been working on. That's like that's a bad end to the story. Although I know that may happen. What can we do as entrepreneurs and have thought into our trusts and estates and business holdings and different things like that versus passing off cash and stocks? So I really love the way Jay turned his business and his passion, managing billions of dollars of assets still today, to an enterprise in a trust that he can pass on to future generations. I think that's a huge lesson for us to take as people listening to this on what we should be doing with our estates down the stream.
As I look at the cover of this book, Family Fortunes, the subtitle is How to Build Family Wealth and Hold On to It for 100 Years. And I thought it was really interesting when you said, so I would pass it on to my 2 boys and they would get 10 and 10. And do you remember his response to that? He said, you're just trying to make it 3 generations. Like, you won the game.
Yeah.
If you could figure out how to make it 3 generations. I think about in this subtitle, it's 100 years. I don't know. Isn't it about ballpark these days 30 years old, people are having kids. That's the center point. It's about 100 years. So you make it about 3 generations.
Yeah.
I never really put that together, that the game isn't to create 10 generations. The game's to make it to 3.
Yep. Love that, Rich. And certainly, if it's not too late for you to sign up to the Entrepreneurs United Empowering Experience, we are going to have Jay there for a wine tasting in Winston-Salem. So we'll be able to have our exhale moment with him and hear a little bit more about his stories as we sip some wine and exhale. So, Rich, can't wait to meet Jay there and look forward to the next conversation next week with you.
Yeah.